have a good real estate opportunity, it's not going to wait months. You need to be able to close on that pretty quickly, usually within a week or two.
In 2008, in the middle of the financial crisis, High West Lending was founded. At that time, banks were not giving loans and some were having difficulty staying open. Our next guest saw opportunity amid the turmoil and is now the go-to choice for private money lending. We're fortunate to welcome Corey Dutton to the show. Good morning and welcome to Mountain Money.
Good morning. Nice to be here with you guys.
Awesome. Hey, so can you please tell us, what are private money loans and trust deed investments?
So in a nutshell, you've got bank financing, you've got loans from banks and credit unions primarily, and then you've got shadow banking, which is it's frequently called in Europe, right? Those are private money loans, typically using real estate as collateral. Now, trust deed investments, how are they different? Same thing. We're still talking about private money loans. However, depending on the state in which you're doing these private money loans in, some states are trust deed states. So when you do a mortgage on a property, it's either called a mortgage or it's called a trust deed, depending on the state. So in Utah, we're a trust deed state, so that's where you get the term trust deed investments.
Perfect. And private money lending is exactly that. It's private money that you've raised and you loan. And is it mostly real estate you're doing?
Yep, it's all real estate. Real estate is the collateral for the loans, yes.
Gotcha. So you write loans, and you also gather up investors who will give you a bankroll that you can then loan. Beautiful. I like that idea. So people don't have to go to a bank. That's correct, because as you know, banks, if you've gone for a bank loan recently, it can take months, and when you have a good real estate opportunity, it's not going to wait months. You need to be able to close on that pretty quickly, usually within a week or two. And so that's the benefit and the difference primarily between the type of loan that I do and a bank loan.
So there are a couple of differences I'm sensing. One is speed, and one is sort of the nature of the underwriting process. And those two are obviously very well related. Talk to us a little bit about how and why what you do from an underwriting perspective differs from what a bank does.
So really, the majority of the borrowers that we lend money to are bankable. They have good credit, they have good income, good financial assets, but it's sort of like you hinted to, the speed is an aspect of it. So really our underwriting, the only way that it really differs is that it's a lot faster, right?
And the way you build an institution, to sort of go on what Kevin said, we think of banks. Banks are, there's a series of depositors that create a pool of capital from which they can make their loans. You're obviously a much smaller private operation, so you basically gather up a series of private investors who create, is it a partnership or a corporation that then turns around and lends out the money?
So mine is a little bit different. So there's two types of funds. You have a typical debt fund where you just wire your money to this fund and then they give you an annual rate of return. You have no control over which assets that you're lending on, essentially. You have no clue. You're just getting a check every month, essentially, for that rate of return that you've agreed to. We're structured a little differently. So we're very boutique. We're very one-on-one with our investors. And so initially, it's very active in the sense that the investor gets to choose which asset.
Oh, wow.
Right, that he or she wants to lend their money on. And so it's very individualized. But once that loan is placed, then it becomes passive. They just kick back, they get a check every month and until that loan pays off, and then they get their principal back. So it's essentially an interest-only loan. They're getting an interest payment every month, sort of like what you pay to the bank, except no principal. And then at the end of that loan term, they get the principal back in a balloon payment.
And how long is the loan term generally? I mean, is the interest rate a little bit higher with you because it's fast, so therefore they will go and take the time and get a new mortgage and pay it off fairly quick?
Correct. So that's where that term bridge loans comes from. A lot of people are familiar with that term, right? So it's a bridge between now and a future event, whether that would be a refinance with your bank at a later date or a sale potentially, or possibly maybe another equity injection where you're going to sell another property, take that equity from that property, bring it in and pay that loan off. So it is definitely a higher interest rate. You're paying 10 to 12% annually for a loan like this, right? And you're paying for the speed, like you said.
So if I was a house flipper this is exactly what I need.
Absolutely. Yep. And all different types. I mean, we lend to individuals as well. So not just real estate investors. We have people that might be relocating for example, from Florida to Park City, right? And they've got to sell a couple of assets in Florida before they can buy that house in Park City with cash. But a lot of time they have a significant amount of cash, so 50% or more. And so we do a trust deed in a first position, a first mortgage, until they sell those assets in Florida, hypothetically speaking, right? And then they pay the loan off, usually within a 6-month period. A lot of our loans are 3 to 6 months in term.
And how would you break down? What's the breakdown of the nature of your borrowers in terms of sort of professional real estate developers, individuals, and sort of other?
That's a good question. Let me think about that for a second. So I would say probably 50% is going to be real estate investors that are looking to take advantage of opportunities, right? And then the other 50% is broken down into, I would say, about 25% individuals, like the example I just gave of the couple moving from Florida to Park City. And then the other 25% would be business owners. A lot of business owners have these assets, real estate assets that are owned free and clear or have very little debt on them, and they want capital for inventory purchases to fund capital investments in their business. And so about 25% of our loans come from business owners.
Now, so how does that work? So if I owned a property and I needed to raise money for my business, I would mortgage it through you to get capital.
Yep.
To then invest into my business.
Absolutely.
Well,
yep.
That's genius.
Yes, it's great. It's because, banks don't do cash out refinances very easily. It's extremely difficult, especially if you own a property free and clear without any debt on it. It doesn't matter how good your credit is. It doesn't matter how good your income is. It is very difficult to pull that cash out. And it's very expensive. Typically, if you're going to get a cash out refinance loan from a bank, you're going to pay sometimes 2 percentage points higher for that money than you would for just refinancing the existing debt.
So even if I wanted to remodel, so if we have listeners out there say, hey, I own my house, I've had it for enough years, it needs some work, and they want to make it bigger, remodel, whatever, they can cash out with you.
Yes, it's so much easier to do that because, so let's say you wanted to do a $50,000 remodel, right? And I came in and I did a bridge loan on that and gave you that $50,000 to do it. Well, now it's not a cash out refinance. So now when that's done, you can go back to your bank, get an appraisal, and now you're not doing a cash out refinance. You're just paying off existing debt that I gave you.
So that's the beauty of the bridge. Is that I was sitting here trying to think, okay, why would I do that? Okay, why would I like to do a remodel? I got a short-term loan. Where am I going to get the cash to pay that back?
Right.
And the answer is that by doing the improvement, it's the appraisal that allows me to do a refinance that isn't cashed out, right?
Right.
Except to the extent of paying you off.
Right. And another example that is pretty frequent with us is, let's say you're selling a home. A lot of people out there, unfortunately, they do not have these cash reserves sitting there. So when they go to sell their house, if the inspection finds something, it needs a new roof or there was flooding in the basement and we need to do some mitigation and we need to repair the damage from that flooding, a lot of people don't even have $10,000 in their bank that they could cover something big like that. So what happens is in essence, when you're selling a property, if you've got, let's say, a $10,000 problem, that $10,000 problem can cost you $50 to $100,000 on your purchase price or sales price of that property, right? And so we do a lot of that too, where realtors will call us and say, inspector found this. They don't have the $30,000. We need you to come in and fix this, and we get paid pretty well for that.
Mm-hmm. Yeah. So someone could just take out a loan for $30,000 to do that work. They pay the interest, but then they save so much because it's not going to cost them on the closing.
And they pay it off at closing.
Yeah.
Well, the issue is, though, once you've listed a property for sale, a lot of people don't know this. If you list a property for sale, you cannot get a loan against that property.
You can't get a mortgage.
You can't get a HELOC or a regular refinance because the bank wants you to have that money for a period of time so they can get their interest, right? Whereas with us, it's an interest-only loan. It's short-term basis. We're turning that money over and over so quickly. So to us, it's really not a matter of trying to keep that loan as long as possible. We really would like to get paid back as quick as possible.
So you've been around 17 years, since 2008, as we mentioned. In those 17 years, do you have a dollar value of what you have loaned out?
Yes, definitely. I'm very proud of it. So over $550 million in loans I've done since that time. Now, compared to some of these large debt funds, that is just nothing. That's like 2 or 3 years, right? And so
Yeah.
that's over 17 years. But I'm pretty proud of that because we're a super small boutique company. We're a lifestyle company. We keep it small. We keep it real. We really try to live our lives and enjoy our lives first and put that first. And then the work comes second. And so I'm pretty proud of that because I've been able to live a pretty good life out here in Park City.
Yeah. And are you just here in Park City or say Summit County, the whole Wasatch back? Or
Yes, I lived in Park City up until about 10 years ago, and then we moved out to the Camas Valley. So now we live in Francis, which I love.
Francis is nice.
And what was your background? How did you end up in this business?
Okay, great. Well, so I got my MBA and with a focus on international business, and I thought that that's what I was going to do. I moved to Utah because I wanted to, snowboard. I wanted to mountain bike. I wanted to be living in the outdoors, camping and doing all that stuff. So I said, where can I live in the mountains and work in the city? Because I knew I was going to have to get a job with a big corporation. And sure enough, I discovered Salt Lake City and Park City, how close it is to this big city. And so I purchased a home in Summit Park up at Parley Summit so I could be close to the downtown. And I got a job with a small hedge fund in Salt Lake City. One of the asset classes that they ironically invested in was trust deed investing. They did quite a bit of that. And so I learned that from them. And then I went and worked for a mortgage company during the financial crisis. The hedge fund sort of folded. And during the financial crisis, I had a mortgage company that recruited me to help them do marketing. And that's how I learned the mortgage side of things. They also folded, unfortunately. Yes. And so I started Private Money Utah, which was the original company before High West Lending, and ran with it. And I've been running with it ever since because banks, as you mentioned at the beginning of the program, were locked up at that time. As we know, many of them closed their doors. So I started out actually doing foreclosures. I got a bunch of investors and we put some money together and we started lending money on these foreclosures. And that's kind of how I got started with it.
All right. So since you mentioned outdoors, I understand you were behind the creation of the Slate Creek Trail out in the Uintas. Tell
Yes.
us more about that. What's the organization you're working with on that?
Definitely. Many listeners have probably heard of the Slate Creek Mountain Bike Trail up in the Uintas, trying to get out of the busy Park City mountain bike trails up here, and have discovered it. It's about 4 years old. The South Summit Trails Foundation is a small trails foundation, very similar to Mountain Trails Foundation in Park City. It's been around since 2016. I am the president of the South Summit Trails Foundation. So that's what I do in my free time. I build trails out in South Summit County. One of the things I discovered when I moved out to Francis and in the Camas Valley is there's really not a lot of trails out there. So I immediately sort of discovered that it was time to build trails out there. And so the Slate Creek Mountain Bike Trail was the brainchild of a bunch of individuals that founded the Trails Foundation, namely Tom Noker, which many people know that name in the community, Adam Brown, Howard Sorensen, Doug Evans, and $350,000 later, we have this trail. So I primarily my function there was raising the money for that trail.
I want to go back to the lending business for a minute, and right now we're in a period where the future of Fed funds rates is really uncertain. We don't know if they're going to continue to cut them. Talk to us a little bit about the interaction between what the Fed does and the interest rates you have to charge. How do those things link up?
So as we all know, or many of us know, the federal funds rate really doesn't as much dictate long-term mortgages. It's more the 10-year yield. As we saw last week, when the Fed lowered interest rates by 25 basis points, the 10-year yield went up by 25 basis points.
Yeah, why does that make sense?
I personally think, but what's funny is all these theories and fundamentals, as we all know, we've been seeing, are sort of out the window in the last 5 to 7 years. So it's anybody's guess what's happening in the markets right now. In fact, the 10-year yield has gone down this past week again. So it's anybody's best guess. The way we price our loans is sort of, 4 to 5% above the prime rate. So we try to kind of keep it in that range. So as interest rates go down, the long-term interest rates, our interest rates will also go down. And then as those go up, obviously, our interest rates go up.
We just talked about the 10-year. What happened to the prime rate? Did that move with the 10-year?
Good question. I should have checked that.
I'm not trying to stump you. I'm just we hear all this and there's so much in the news about the Fed's moves, and trying to translate that into people's everyday living is something that I struggle with.
Yeah.
Right?
Oh, everybody. I think everybody's struggling right now to try to figure this stuff out, right? Because it's all the fundamentals I feel like that used to apply are sort of out the window, and it's really difficult to guess. It used to be I felt like you could predict things more based on fundamentals that we always went to, these rock hard fundamentals. And now it just seems like it's anybody's best guess every single day.
Yeah, the rates change at a whim.
It's a little disconcerting that someone with your degree of background has the same degree of uncertainty as Kevin and I do about this. But I suppose that speaks more to the way things are. 4 to 5 points above prime. Where is prime right now? So
prime has been hovering right around 7.5%.
Okay, so a short term loan would be in the 12s.
That's correct.
Typical.
So our interest rates are usually 10 to 12, and it usually is based on down payment size or equity,
Yes.
More than the credit score of the borrower or anything like that. Because most of our borrowers are bankable that come to us. We don't lend money to desperate people. We want an exit strategy, and we want a good plan, and we want financial strength from our borrowers. So we really don't deal with anyone with bad credit.
My last question is typical loan length.
Loan length, well, we do 12-month terms, but most of our loans are paid back within 6 months or less.
Okay. And how can our listeners get in touch with you if they want to take advantage of the private money loans, or are you looking for investors as well?
Definitely both. I'm always looking for investors. I don't need money right now. I've got plenty of money to put out there on the street, but I'm always looking for people that understand real estate and that are looking for a way to diversify their portfolio within real estate through the trust deeds. They can find me, both borrowers and potential lenders, at highwestlending.com. I'm also on Instagram, and it's CoreyDutton.lender.
And that's Corey, CoreyDutton. Well, excellent. We just spent a few minutes with Corey Dutton from High West Lending. Thank you for joining us, and we'll be right back after this.